Europe. So a lot of we'll certainly be looking at ARR to see what that tells us about the sector.
Well, here's what else you need to know this morning. Bloomberg has learned that the European Union is warning inflation could pass 3% this year if the war in the Middle East causes Brent to remain around $100 per barrel and gas prices to stay elevated for an extended period as well. We understand that the EU's economy chief, Valdis Dombrovskis, told the bloc's finance ministers this week that under such a scenario, economic growth would also be as much as 0.4 percentage points lower this year than the 1.4% pace that it last forecast. Elsewhere, JP Morgan strategists say hedge funds are experiencing the biggest drawdown since the Liberation Day tariff turmoil. In a note on Wednesday, they said unwinding crowded trades have hit quants such as commodity trading advisors. Equity long-short hedge funds have also posted heavy losses due to their overweight positions in European and Korean markets and their underweight in software names. Speaking of earnings, BMW expects profitability to stay roughly flat this year due to the cost of tariffs and intensifying competition in China. The German car maker sees an automaking margin of 4 to 6% after the measure declined to 5.3% last year. Sales in China will remain broadly stable. BMW has been faring better on EVs than rivals Mercedes-Benz and Volkswagen's Audi, as it kept factory lines flexible to produce cars with different drivetrains. So we are looking to those BMW earnings, see how BMW fares at the open. Big picture though, BMW is in pretty much the same boat as all of the German car makers. You've got to fend off the Chinese brands, undercutting them when you've got that luxury demand waning in China.
Yeah, absolutely. So BYD and Xiaomi, they seem to be the areas of intense competition. Also Tesla to some degree and in certain markets. But also the tariff story is in focus as well. And we've got some clarity from BMW on the extent to which that's going to impact their business. I mean, I say clarity, they have to draw the line somewhere and base these numbers on something. So whether this is post IEEPA, I am guessing so, but maybe it doesn't reflect any move up to 15% tariffs. Who knows where these things go next? But they are saying the impact on the automaking margin will be 1.25 percentage points this year as a result of the tariffs. And all of this at a time when the CEO is stepping down, been there 7 years. So new leadership coming in, but such a lot of change in this sector. Coming up on the programme, we'll continue the conversation on BMW. And we'll bring you our interview with the CEO, Oliver Zipser, at 7:30 that turns up. Plus, how high can oil prices go. We will discuss the outlook for the oil market as the Strait of Hormuz remain effectively closed. But up next, we'll be joined by Mark Anderson, co-head of Global Asset Allocation at UBS Wealth Management. If you have questions, if you want to get involved, please contact the team. IB plus BBTV. That is the function as the sun comes up in London this morning. This is LinkedIn.
Earlier today, the International Energy Agency agreed to coordinate the release of a record 400 billion barrels of oil from various national petroleum reserves around the world, which will substantially reduce the oil prices as we end this threat to America and this threat to the world.
That was President Trump speaking in Kentucky last night. Meanwhile, oil prices have remained volatile despite the announcement by the EIA to release 400 million barrels to combat disruption from the Iran war. Brent crude hit $100 again overnight, went above that level. That was after Oman cleared all vessels from its key export oil terminal, and 2 tankers were attacked in Iraqi waters. Let's bring in Bloomberg's Jumana Basechi in the region for us in Dubai to walk us through the latest developments. Good morning, Jumana.
Good morning, Anna. Well, traders are turning their sights to the ongoing developments, and not just around the Strait of Hormuz, but also now what we're seeing is attacks taking place on the northern part of the Persian Gulf. So 2 tankers off the coast of Iraq. So this is way north of the Strait of Hormuz. Were set on fire this morning, reportedly ablaze. And then further south, also, this is also south of the Strait of Hormuz. Yesterday evening, at the key port of Salalah in Oman was also struck. That's a fuel depot. And you're seeing images now of those 2 vessels outside Iraq, but then equally some flames and the main export terminal in Oman as well. And earlier, out of an abundance of caution, vessels were asked to evacuate the area. Another key export terminal in the region, Oman, exports about 1 million barrels a day of oil through that port, and it is on the Gulf of Oman. It is not on the Strait of Hormuz. And so all this to say that the disruption that we're seeing isn't just around the Strait at this point, but also around the Persian Gulf and the Gulf of Oman too. So an alarming development. And of course, at the same time, the Trump administration has been trying to introduce various policy measures to help alleviate the stress on physical supplies of oil. The big announcement coming from the IEA yesterday, a record release of SPRs of up to 400 million barrels, but not making that much of an impact on the market. And I will say, when the executive director of the IEA, Fatih Birol, put out the statement, he said the most important thing is the resumption of the transit through the Strait of Hormuz, and that is clearly not happening. And just to give you a few numbers here as well, we're getting estimates from various banks, Goldman Sachs, Citi, suggesting that the amount of disrupted oil that is not being able to transit through the strait now is something between, let's say, 12 and 15 million barrels a day. Even if the IEA or the SPR were to go at their maximum capacity, that would amount to 4 million barrels per day. In history as a guide, they've usually gone at a pace of between 1.5 million to 2 million. So that pales in comparison, that 2 million barrels a day that they could release to the market pales in comparison to the, say, up to 15 million barrels a day that's being lost from not being able to transit through the strait. So there's a mismatch here between supply and demand, and an ongoing concerns about security and risk still for any vessels looking to transit the strait.
Imagine an injury law firm that's committed to preventing accidents, that educates the public on automobile and bike safety, and cares for the community.
That firm is CR Legal Team, and our entire team is equally committed to caring for the whole person after a crash, physically, emotionally, and financially. From way before to way after an accident happens, trust CR Legal Team to stand up for you. Call 888-TEAM.
This is Lovable, the AI app builder that turns ideas into reality. From small side projects to enterprise tools, from consumer apps to platforms that scale, built in minutes.
Alon Galloway here at Capital Subaru of Greensboro. Your connection to a massive selection of new Subaru models priced for less. We're always committed to giving you the most competitive offers available. Plus, when you trade in or sell,
Very much. Stay safe. That's Bloomberg's Romana Besetchi. Well, we are looking at US equity futures declining following the lead of Asian stocks and extending what has been already a volatile week as oil prices have rallied after an attack on tankers in Iraqi waters, highlighting the threat to energy infrastructure in the Middle East and stoking concerns of an escalating conflict. Joining us now for analysis is Mark Anderson, co-head of global asset allocation at UBS Wealth Management. Good morning to you, Mark. I wonder, do you see anything sustainably lowering the oil price other than the reopening of the Strait of Hormuz? Because surely that puts the power in the hands of Iran and suggests that this could be a protracted conflict, and it doesn't seem the market's pricing that.
It certainly does look like it could stay to be a protracted conflict, and we're really working off two scenarios here. We have one scenario that where we within the next, say, month or so would see oil starting to flow through the Straits of Hormuz. This situation where either through diplomatic measures or through some military intervention by in particular the US would sort of allow oil to start flowing. That's a world in which we see oil prices moving back to a level of around $70 to $80 a barrel and not really having any significant impact on the global economy through sort of demand destruction or inflation rises. And then there's obviously a more negative scenario where oil prices will stay above $100 a barrel for, say, several months, 3 to 6 months, and therefore starting to have a real impact on the way we think about the economic outlook, central bank actions. And that's, of course, what we're trying to work with here for our clients when we construct portfolios, is trying to think about, with these two scenarios, how can we somehow both insulate portfolios against some of these events for our global clients that are obviously challenged on one hand side, and also potentially see some opportunities as events they are unfolding here.
Well, how much upside do you see for US equities if the Strait reopens?
So we do think that we could see a rally back to some of the pre-levels that we were seeing before the strike. So we think we'd see a relatively quick move back towards sort of the highs where we were before. Very similar with bond pricing starting to move back, say on the US 10-year back around 4%. But as I mentioned before, the very challenging thing here for investors is certainly the fact that all of a sudden we have two of the main asset classes here, equities and bonds, which is typically the core parts of a diversified portfolios that are being hit at the same time. And that's what is making these supply shocks so challenging and why these sort of a heightened level of geopolitical uncertainty is difficult. One of the ways that we try to insulate portfolios from such situation is by going back in time to see what are the type of assets that will be, the most uncorrelated, maybe even be doing well in these sort of situations. That, of course, it's easy to talk about commodities now because we see, Brent on certain types that will be doing very well, inflation protected bonds. So these are the ways to try to, insulate portfolios in times of heightened geopolitical uncertainty like we're in now.
Mark, good morning. We are watching European bond markets open up, and for the second time this week, digesting the fact that oil prices have touched $100 a barrel, even if we're just back down below that now. I'm just looking at the French curve, for example, up by around 5 basis points at the 2-year horizon, up at 3 basis points the longer end. What kind of higher yield environment are you starting to think about for the rest of this year, or are you still base case thinking that for the whole year we're not going to see higher yields?
So what the market is obviously pricing in right now is that when we're seeing higher oil prices, the risk is that inflation is going to spike. And what we've heard now recently from the European Central Bank is somewhat more hawkish comments in the event that we were to see oil prices stay at sustained high levels, same with natural gas. And that's sort of a place where central banks have to think about that part of the mandate where inflation shouldn't be getting out of control. And we would see these second round effects of inflation starting to spill over into other areas. But of course, when we start to think about what yields might be doing, there's sort of two phases here, right? So if we were to see inflation staying higher driven by energy, that would eventually lead to demand destruction. So as much as we're thinking about central bank hikes, maybe in an initial phase, eventually we would see demand drop and very likely we'd see inflation be coming down, therefore central banks actually cutting rates. So I think, how to think about yield curves becomes a bit more complex than say the pure equities where the direction is more clearly down if we were to see inflation
Yes.
staying higher. Where on the other hand side, bond yields might actually eventually be falling on worries about growth instead of only focusing on inflation as we're doing right now.
Yeah, bond market certainly focusing firstly on inflation, but as you say, Mark, that could change and growth could be at the forefront later on. What about emerging market assets then? Because emerging market assets have been very popular ahead of this conflict. Since the conflict, maybe a little more challenged by some of the dynamics, certainly around FX, but you still like some emerging market assets. Tell us more about where you're leaning into there.
Yes, of course, part of the emerging market space is down at a time where we are both on one hand side seeing very cyclical assets being challenged. We've had part of the emerging market space in Asia doing particularly well. So I think there's a little bit of profit taking. And then, of course, if we continue on the track of Asia, very, very large importers to part of oil out of the Middle East. So these are areas that are being challenged these days. If we go on a little bit of a broader perspective here, we also have parts of the emerging market space that have attractively yielding currencies. You know, some emerging markets that are commodity exporters that are doing reasonably well. So one of the investment themes that we have been having for our clients, and something that we have actually added exposure to as this crisis was unfolding, was around currencies that were higher yielding commodity exporters. So in the developed world, this has been places like the Norwegian krona, the Australian dollar, but we have also been allocating to other places like the Brazilian real, Mexican peso, South African rand. So countries that, you know, again, have commodity exposure, high yielding currencies, and we have used the opportunities of weakness to add a little bit of exposure here, balanced with some hedges by adding US dollar exposure as well.
Yeah. Mark, thank you very much. Mark Anderson, co-head of Global Asset Allocation at UBS Wealth Management. Thank you for joining us. And it's interesting, Lizzie, we are seeing yields go a little higher this morning. The market's still focusing on the inflation impact, to Mark's point, but it is possible that as this continues, maybe bonds start to play a different role if we're all worrying about demand and growth.
Yeah, and you wonder how portfolios start being rebalanced if those inflation concerns remain. It's interesting as well, we were talking about that fundraising by Amazon and how, you know, when you're thinking about credit, perhaps you start going into corporate credit rather than treasuries as you look at these moves in the bond space. But yeah, not huge moves this morning when we're looking to what's happening in Europe.
Yeah, we'll certainly look at gilts as they open up in around 35 minutes time and bring you the opening pricing there. Coming up, we're back to the corporate earnings story. BMW forecasts flat profitability due to the cost of tariffs and intensifying competition.
Just under 30 minutes away from the start of the opening trade, and it's set to be a risk-off Thursday. Futures pointing lower on both sides of the Atlantic. The FTSE set to be somewhat cushioned by its exposure to energy. We have had Brent up nearly 5% to $96 a barrel on the latest events in the Middle East. Threats to energy infrastructure outweighing that record release of reserves by the IEA. And let's get to the earnings picture. We are going to be watching BMW at the open after it said that it expects profitability to stay roughly flat this year due to the cost of tariffs and intensifying competition in China. The company's CEO told Bloomberg that there's been no impact on BMW from the war in the Middle East. Bloomberg's chief Europe correspondent Oliver Crook spoke with BMW's Oliver Zipser.
Any war in this world is utmost unfortunate. But currently, we must observe the developments very carefully. The situation is volatile, so every day we have a look at our supply chains, of course. But at this point in time, we don't have any interruptions towards our production or in the markets. But currently, it's too early, and everything else would be speculation.
And at what point do you get concerned that it could have a bearing on your supply chains, on the deliveries of cargoes and the energy input costs for suppliers that could then trickle down to BMW?
We currently don't see that because the supply chains we depend on are not in the focus of current blockages. So currently we don't see that. And if that is going to happen, we will respond like we've always responded in the past years. We had in the 2020 Corona year, after we had supply chain issues on the semiconductor side, we have energy issues. And so we will respond as always. We will have a very close look all the way from raw materials to the final production plan. And we kind of train that muscle to have a very, very quick overview of what is happening. But again, currently we don't see any disruptions in the supply chain as we speak right now.
And I'd like to get into some of your forecasts for 2026. We know that they're obviously sometimes vulnerable to some changes, but in 25, we saw sales in China down by 12.5%, in the Americas up by 5.6%, and Europe up by 7.3%. Is that the trend that we're going to see going into 2026? What forecast do you see in each of these key markets? Could you break out? You said that there's also going to be growth in Europe and the United States. You guys didn't give a figure. What kind of growth can we expect there, and what do you expect in China?
Right. Stable. It will be more or less in all the markets comparable to last year. That's why our guidance is on the level of this year. But this year we launched our Neue Klasse as well, which went here in Germany to the market just last week. We have really satisfying order intake, and we are very, very content about the future outlook of the Neue Klasse. And that will start this year and will continue next year. So overall, with all markets combined, we will see a rather stable environment overall at BMW. And we don't have to change our strategy. We will respond wherever markets have a demand, and we will respond on the electric side. We will respond on the high performance side. We will respond on the ultra luxury side and on the base segment, and that kind of gives us that stability. And neutrality helps. It's just
And now that we're
simple. Neutrality helps here.
Yeah, and
Yes.
and we're about a year since we got Liberation Day, the sort of big tariff relief from the Trump administration, the big tariff reveal, I should say, from the Trump administration. A lot of chaos ensued after that. Now that there is a slightly more stable tariff regime, do you have a clear idea of kind of what this tariff picture looks like going into the United States, the effect that it has on the P&L? And now, basically a year from that, how does that govern your strategy in the United States? Are you now open to the possibility of opening new production lines? How are you thinking about strategy in the United States given the tariffs?
Yeah. On a more global scale, we see more and more protectionist moves, which harms everybody involved. This industry is globally fully connected, and that's unreversible. So any form of protectionism, we have to consider, is that the right path for the future? Concerning your question towards the United States, at this point in time, we pay currently higher tariffs into the United States, 15%. But at the same time, we still pay the remaining 10% taxes, not the 0%, which was part of the Turnberg review. And our request is, and I make that quite clear also in my discussions in the United States, to bring that down on the European side now to 0%. That would help a lot. But on the other hand, we are kind of protected because our largest plant stands in the United States, and whatever is in the United States, it's kind of naturally protected. Again, in 2025, we were the largest exporter of cars in value from the United States to the rest of the world. And our second demand is that we kind of build up an offset system. Very simply speaking, for every car we export, we can import one. And that would create a lot of stability for jobs on the one side in the United States and also for global business wise.
Canon EOS R50. Time for your best video yet.
What's your favorite thing about your partner?
She's funny.
He's open-minded.
Before we got married, we said the worst thing we've ever done.
That's the worst thing I've ever done.
What the?
Listen, Joanna, I was drunk.
That's a huge red flag.
Please stop gossiping.
The happy, carefree couple.
fairly calm Oliver Zipser there, possibly the BMW CEO, speaking to our Bloomberg TV Europe correspondent Oliver Crook. That conversation in the results domain this morning. We'll certainly watch BMW shares at the open. We'll also watch shares in M&G, the asset management business, also reporting numbers this morning. Adjusted operating profit coming in ahead of estimates. The company says it is on track to achieve its target of 2.7 billion cumulative operating capital generation. We will focus in on that conversation now. I'm pleased to say we're joined by Andrea Rossi, who is the CEO of M&G, with us on set this morning. Good morning to you.
Morning.
Thank you so much for coming in. Let's start with the earnings picture then that you're delivering this morning, and then maybe get your views on what's happening in markets right now. The numbers coming in better than expected. What's the message to investors this morning along with these numbers?
Well, we're very pleased with the set of results that have laid our foundation for profitable growth. And I'm particularly very pleased with the fact that our businesses are growing again. We had amazing net inflows on the asset management side with 7 billion of net inflows and quality inflows because we had it both in public assets and in private assets. We also continued to grow our life business, and we had 1.5 billion of sales, doubling our market share in the PRT market. And we also saw strong momentum on our flagship True Fund with net inflows in the second half of the year. So very, very pleased with the growth, and that has been supported by amazing client outcomes. I mean, our investment performance for our clients have been stellar. In our public markets, 75% of our funds is in the first and second quartile. So very, very pleased with that. And that, of course, has given the very strong and resilient profit results. We are coming out with a dividend per share up 2% year on year. So very, very pleased with that.
So you're pleased with the inflows, so pleased with the amount of money coming into the business, and then you're pleased with what your colleagues are doing with it and on behalf of clients and how they're managing it. What do conversations with clients look like right now, Andrea? We are in an incredibly volatile environment. Last year felt volatile. This year feels even more so, perhaps. I wonder where investors are focused and what they're talking to you about. What do they want to bring to the fore?
Yes, I mean, the markets have been volatile since a while. I mean, let's not forget we had Liberation Day one year ago, and that created volatility. These are the time where clients are looking for an active asset manager. That's when an active asset manager makes a difference. Hence, also why we had those great flows in 2025. And at the moment, obviously, it's early to say what this existing war is going to do, but clearly, it will create volatility. We see oil prices being at the top. We might see what banks are going to do in terms of rates. There is fear for inflation. So it creates a little bit of uncertainty, and clients want to see where they should invest in. That's why they come to us, an active asset manager. We diversify. We're strong in private assets. We're strong in public assets. We are focused on Europe and Asia. And we're having a good conversation. At the moment, it's too early also to say whether clients are risk off or not. At the moment, it's still very, very early. So,
if I could focus on the private side of the business, you've got one of the biggest private credit evergreen funds that's open to affluent investors in Europe. Have you seen higher redemptions so far this year?
Well, we have only one evergreen fund. It's our LTIP. It's a credit, corporate credits, and it's 1.1 billion. That's mainly seeded by our own life balance sheet, and it has institutional clients, so we haven't seen any redemption at all on it. And once again, when you're talking about redemption, I know the market is very focused on this, particularly on private credit. You have to make sure you match long-term with long-term investors. So as long as you have institutional investors, our own balance sheet, that does not create a problem.
Yeah, I do wonder how you view this balance between maintaining confidence and protecting those long-term investors. If you did see